What is your current assessment of the global economy and financial markets?
I think in the first half of 23, we're going to start seeing the sudden stop metaphorically, where you're going to go from the offer side, they're going to show up to refinance and realize we can't refinance. Hit the bid, hit the bid, hit the bid. And once we start hitting bids on a blown out offer, bid-ask spread, it suggests risks of very binary shifts to asset prices, economic activity, in big stretches of the financialized economy. So that is, I think, the nickel tour, or the 3-minute, 5-minute summary of where I think we are as we're sitting here today.
What inning are we in, and what are sort of the next material developments you expect to see at the sovereign level?
From here, things start to get interesting with with U.S. tax receipts beginning to decline, and likely to decline more and potentially non-linearly if we have a collective or sequential moving in the borrow short, lend long part of the world from the ask side to the bid side.
About the increasing amount of liabilities and entitlements, and when you kind of add everything together, there's not much left over. And I know you've been worried about that gap is getting worse as time goes on, but now it's been potentially dramatically accelerated by the increase in interest rates, because just the interest on the federal debt becomes that much more of a problem. What are the latest numbers on that? Like, how much has it increased over this year?
I think we're about to see Treasury spending as a percent of tax receipts, which peaked out at like 110% in 2021. Early 2021, they fell to 85, 88%, maybe 90% of tax receipts. They're going to probably get back above 100% of tax receipts at some point next year, probably late in the first half, early in the second half. Once that happens, you're into a situation where the Fed's got to either print the difference, or which is dollar negative and risk positive, or the resulting, basically the U.S. Treasury is going to crowd out global dollar markets. And so you're going to see the regime we saw this year, which is rates, all else equal, dollar up, rates up, everything else down. And it gets to a very binary situation. So we're rapidly accelerating toward that. And the pace at which the Fed has hiked and the lagged impact of those hikes are merely going to accelerate that, not just accelerate it, but probably make it very nonlinear in some point in the first half of next year.
Could it be this deficit now, right, that we're now over 100% of tax receipts? Could that reality be what forces Powell to have to deviate from what he has said he's going to do? Hey, you know what? We're going to have to print up these treasuries, or issue these treasuries. I guess I got to step in to fix things here.
Yeah, I don't think he wants to, but I think that's ultimately what it was always going to be, right? I think we were seeing that those concerns start to reach a crescendo in September and into October, with the volatility index in treasuries, this heightened discussion of treasury buybacks that was happening, the problems the UK had, the problems Japan was having with the yen. You were seeing all of this accelerate very meaningfully. And then we had this IMF meeting in mid-October in Washington, and all of a sudden, I don't know what was said, but in that time, in the intervening period, we have had these liquidity injections. The dollar has gone from 114 to 104. The treasury market has been bid. You've seen this respite.
Yeah, and sorry to interrupt, but was this just sort of the rest of the world getting in a room with America and saying, "You're killing me, Smalls"? Right? This high dollar is just it's strangling us. We need you to bring the dollar down a little bit to give us some respite here.
The interest broadly defined, right? When you start having the borrow short, lend long world, whose P&L statement has to look like what the Fed's operating statement looks like, these remittances, which is, hey, everything's great, crash. That's fine. They can go for a little bit. At some point, they have to refinance. And when they go to refinance, from here to here, the bank's going to go, we need margin. And they're going to go, we're done.
Yeah.
And that's just going to happen across that whole world. That's going to replay into tax receipts. And so we're looking at a world where in the first half of next year, we get more of these treasury statements, which go from, oops, we thought we were going to borrow 400 now, oops, it's 550. And then in 1Q, we thought we were going to borrow 5, oops, it's 7. And 2Q, we thought was going to be 6, and it's 900 billion. And that gets into this treasury issuance number relative to the available balance sheet question. And that will not be a linear conversation. That will be like, everything's great. Holy cow, we have a full-on crisis.
I guess what I'm just trying to emphasize for folks here is the fact that it is a very enmeshed game of many different players, and we can look at our specific situation here in the US, but we can't look at it in isolation. We've got to take it in mind both with our allies and with our potential adversaries.
Our job is to run deficits and export treasuries, and the more we do that, we're not going to make stuff. The Chinese are. So you've got sort of, for example, in the US, this wing of, okay, the Make Bonds Great Again group against the sort of the realists of, okay, we did a bunch of dumb stuff and this isn't working for us anymore, so now we need to inflate. In Europe, you've got sort of the Atlanticist wing where, hey, whatever the Americans tell us to do, we do. If they tell us to jump off a bridge, we go jump off a bridge. And then there were the realists of, like, the Russians are there. They've got all this cheap energy. We need cheap energy to compete with the Chinese. Let's do that. And we've obviously seen those competing wings that has broken down. That's been something that's been very fractured over the last 6 months for a number of different reasons. China, you've got sort of the the domestic export centric classic power structure against the wanting to move away from that and hardliners, harder liners within their political establishment. So not only do you have the dynamics with the countries, but then you have the dynamics within each of the major players fighting against each other. So there's, for me, it's a very, very chaotic time to try to analyze things. There are no clear, there's no clear answers about a whole lot at the moment.
We are seeing more and more companies looking like they are getting more and more of their manufacturing out of China. Some of it might still stay in Asia, but some of it may be going elsewhere. Is that board game getting pretty mixed up at this point, or is it going to take a long time?
I think it is still moving in that direction. You've seen some things have helped it. I think others have hurt it. I mean, obviously there's shutdowns this year with COVID have been, I think a huge net negative for them. You sort of has moved them now into survival mode. Now they look to be rolling those things off. Let's see. What does that mean? You start seeing Chinese oil. I mean, oil's $75 with China heavily shut down. What's oil if China's reopened?
China reopens.
And what does that do to the Fed? Who's starting to break stuff anyway? If oil reaccelerates from here, now what? The Fed's going to face this choice again in first half of that they last faced in the second half of 2007, which is, oh God, the financialized U.S. economy is breaking. We need to cut rates. At the same time as, oh God, oil's rising. We need to raise rates because it's going to filter through to inflation.
Right.
And now choose. Are you really willing to blow up the financialized U.S. economy? They keep saying they are, but I'm not so sure.